Hi, Steve Sosnick here with today's Interactive Brokers Morning Market Morsel. Well, yesterday was an interesting one, no? And we're starting to see signs of stabilization today, but we're getting that kind of volatility that you see after a big move. And depending on when you're looking at this, we could be somewhere vastly different than where we started the day. That's pretty normal. Look at the future. If you look at the futures movement overnight, we'll talk S&P terms. They were down 20 points. They were down 12. They were back down 20. They were flat at the open. They tried peaking a little higher after the good economic numbers. All this is normal after you see such a volatile day because markets really have trouble finding their footing. And you shake some people out, and that tends to be bad. If there's a lesson to be learned from this, markets take the stairs on the way up and the elevator on the way down. And that's maybe not the best metaphor, but I think it's a pretty good one. Markets tend to move ahead slowly and slowly and slowly. That's when you also see volatility compress because it looks like, oh, we're just going higher every day and there's really no reason to hedge. What's the difference? We're just moving up. But then we fall out of bed very quickly and people get dislocated. Some of the reasons for that, I think, are the following. You did start to see the weakness coming in as the calendar turned. I think there was good support into the end of September, end of the quarter. And as the calendar turned to October, you still had the problems that are working against the market. Interest rates are not favorable right now. For the first time in a long time, cash is actually offering some alternative to the equity markets, meaning that you can invest 3 to 6 month treasuries for 2.5%, that kind of thing. And the yield curve remaining flat as a pancake just has other deleterious effects. But as that spread starts to widen, market takes notice. Also, an interesting little factor is you're getting into earnings season, and companies have to retreat from their buybacks as earnings season approaches because they get into the quiet period. They can't be seen as manipulating their stock, buying in advance of news as earnings approach. So you had these gaps. You saw the market, let's say on Monday, fall sharply and then bounce in the afternoon on light volume because it was a semi-holiday in the U.S. And you saw similar action on Tuesday. Well, by yesterday, either the buy the dips ran out of steam or they just got swamped. I think you didn't have the marginal buyer in corporate buybacks in many names, and that's a case-by-case basis. But with earnings season starting in earnest later this month, you can argue that many of them had to step out of the market. These all work against it, and we'll have to see where it goes. Hopefully you run into this thing reasonably well hedged. If you haven't, you really should be considering where to do it. Do it judiciously because vols are higher. And if you're really that worried, maybe you should be taking some risk off the table. People tend only to worry after the event, but perhaps you may want to think about the factors that are driving the market. Think about your own risk tolerance, and you should be doing so after you have a move like that. If you can't withstand a 3%, 4% move, it means you're taking too much risk. If you can withstand that and see that there are opportunities, good. Look for them. There's plenty of them out there. There always are after a move of this nature. Good luck. Take care. Bye-bye.